So today's Cardinal Lesson, we're talking about these new Trump savings accounts for children, and they're tax advantaged accounts. And for our audience, for you, for the listeners, it's a way to give money to your grandchildren for future needs. And this was signed into law in July of part of the OBBBA Act. And this was a side note, hadn't been talked about that much. And so it's really just to encourage long-term savings for children to have them start to build up a savings account. Tom?
Yeah, so we'll go through the why here like we normally do, but the why of this video, like Hans mentioned, is these accounts and a lot of our viewers, and this might be you, like to give money to their grandkids, right? They want to set things up, they want to make sure they're taken care of. And this is another type of account, is a way to gift that money, another avenue. We'll go over the differences between other accounts a little later in the video. But again, you will need to know how it works, because if you don't, you're going to miss things and not do things the correct way. So we'll get into it. We'll walk through the video. Let me bring up the show notes. You can find these below the link our video. They're also on our website at cardinalguide.com. We have the board as always, and then again we have a article that was written by Denise Appleby, which we go to conferences and hear her speak quite often, really about sort of some of the challenges that the accounts have from a reporting standpoint, more about on the custodian side. So you really don't need to worry as much about that. But then sort of later in the show notes, we have some more just sort of general information that we'll go over on the board here. So if you want a little bit more meat than what's on the board, go look at the show notes. But we're going to go and sort of go piece by piece on this board here. And so Hans already hit kind of the first two. The next one on here that we listed is it's really a way, and probably the best way to use it is for certain things. Higher education, first-time home purchase, those type of expenses. It follows similar rules to IRAs. So in traditional IRAs, there are certain things that do not have a 10% penalty on. Just as a side note, if you don't know this, traditional IRAs, if you withdraw money prior to 59 and a half, there's a 10% penalty on top of the taxes owed, except for a list of exceptions. And some of the bigger ones are higher education, first time home purchase. Some of these have annual limits on that. So, again, we have some time to go into that. If you have questions, call us. But if you just look up the 10% penalty exceptions for IRAs, these accounts are going to follow those same type of rules when they're established. I'll turn it back to Hans. We'll keep going here.
Okay. So for babies born from January of this year, 2025, all the way through the very end of 2028, it's a 4-year period. If you open one of these accounts, the government is going to seed $1,000 in there. So when you cut through everything, if you have a grandchild born during this period of time, you might want to think about taking the free $1,000. So, Tom?
Yeah, I mean, I'm gonna do that. Like my wife Chelsea, we're expecting one here really any day now, and we do have two children that were born previously, so they're not going to get that extra 1,000. But certainly, I'm going to open the account for our new son, who's going to get $1,000 is a free $1,000. Certainly, I'll take that. On the next point on the board here, though, is children that are these accounts are for any child under the age of 18. So my other two who were not born in that window, we could also open accounts for them. We could put money into there based off the limits we'll get into a second of how much we're allowed to put in. But they're not going to get that free $1,000. So, but certainly if you have a child or a grandchild born in this window, absolutely, I think you should open the account. A free $1,000 is better than nothing, right? So take advantage of that, if nothing, for the fact to get that $1,000. If you have other kids or grandkids, you probably, just to make it fair, probably would want to open an account for them too, and just put $1,000 in yourself just to keep it all equal. But again, that's up to you. You could make the call on that. But anyone who is under age 18, these accounts are available for.
So parents, relatives, which grandparents, guardians, and employers can contribute up to $5,000 annually, contributed after tax. So the money going into these things, you've already paid tax on. The beneficiary of this child later will not have to pay taxes again on the contributions. It's only on the earnings. But you can put up to $5,000 into the account if you're the only one doing it as a grandparent, but collectively it can't be more than 5,000 contributed in a year, and that is 2,500 for employers. Tom?
Yeah, I mean that's sort of the limit that you're allowed to put in, 5,000 per account, and so like Hans mentioned, employers are able to do that. We'll have to wait and see how much these are adopted across the board. But again, I think it's another vehicle, and there's limits there. One of the things that are a little bit trickier, right, and this is on the custodian side, is the basis. The initial investments are going in after tax, and then the growth is tax deferred. So that's really the next point on the board. So tax deferred really just means that as it's growing, you're not having to pay taxes while it's growing. Compare that to just a brokerage account. Like if I went out and opened up an investment account with like Charles Schwab or Vanguard or Fidelity and put money in there, as the account grows, if I sell something, it's going to be subject to capital gains. Or if there's interest or dividends created in that account, that would be taxable. Tax deferred, like this account is, like IRAs are, like 401k is, you don't have to pay tax on that growth until you withdraw the money. So that again, it's pushing the taxes down the road. You don't have to worry about it now, and it allows you to potentially buy and sell things in the account, rebalance, do stuff like that, and not have any tax implications. And so again, the growth portion is tax deferred. The initial investment is you put in with after tax dollars. So that portion is what they're going to call basis. That is tracked separately. When you pull that money out, that's not subject to the taxes. It's not subject to the 10% penalty. The growth, though, the growth that's tax deferred, that's where the taxes come out when you pull it out. That's where the potential 10% penalty is if you pull it out prior to 59.5 and you don't have one of these exceptions. But again, that's just it's good to know how the account is taxed on the growth portion of it.
Okay. So the custodian, like Fidelity, Charles Schwab, your bank, whoever's opening up this type of account, they're going to have to track basis and earnings. So they're going to have two accounts within one account. And all the money that was put in there after tax is the basis. And then the earnings is all the money that is earned that has not been taxed because it's tax deferred. So that's going to be a bit of a headache for custodians, and it's going to remain to be seen whether custodians are going to adopt these widely, because it costs a lot of money to set something like that up, but not really your concern. I mean, I guess we're going to have to wait till they actually come out to see how many people are offering them. Tom?
Yeah, I think like you said, the custodian is going to have to track the basis. This is not something you need to worry about, which is again probably helpful. So it's not, again, you don't have to keep track of it. The custodian does. We'll see how many custodians offer this, but again, it's one of the last points, and we'll get to this, is these accounts aren't yet eligible to be opened yet. So we'll come back to that point. The next one is and this is a big one. So upon turning 18, this account is now that child's or grandchild's account. It is their money legally. Where that potentially becomes a problem is if we think back to when you were 18, when I was 18, 18-year-olds historically are maybe not the wisest. They don't make the wisest money decisions out there. And then you add on sort of the 10% penalty, the taxes owed, doing those type of things. There could be issues where people get this money, they withdraw it all just because they wanted to go do something with it, right? Buy a car, on a trip, whatever it is. And that could upend a lot of the planning you're doing. So if you're setting these up, you need to be having discussions with your kids, with your grandkids, on how best to handle it. But legally, when they turn 18, that account is theirs, and they could do whatever they want with it. Similar to, if you're familiar with UTMA or UGMA accounts, that's not what this video is on. Similarly, on those accounts, when they become of age, those accounts become theirs too. I've had some people that sort of don't necessarily tell their kids or grandkids about it. I don't want to get into whether you should or shouldn't do that, but legally it is their account. If they were to, withdraw it, they could.
Okay. So it functions, or it's intended to function, like a traditional IRA at 18 going forward. And we've made some mention of that earlier. So, let's say you contribute over the years and then it earns over the years. And let's just say they have $20,000 in there at 18. And 14,000 of that was contributions, 6,000 is earnings. Okay. And it's going to function like a traditional IRA. But the difference is you're going to have 14,000 available that taxes have already been paid, and you're going to have 6,000 of earnings, and then it just goes forward. So there's a lot of pieces of this where it's going to function like a traditional IRA. We're going to have to really kind of wait and see what they actually come out with the IRS rules on how all that's going to work. Tom?
Yeah, on that point, and we just need further clarification on this, and it's unclear whether this will be allowed. And they'll probably have to provide some guidance either in the law or the IRS comes out. I mean, we'll just have to wait and see. But like, for example, maybe you could eventually convert them to a Roth. Who knows? Or we don't know if that's going to be available or not. We have some time to figure that out. So don't count on it, but it might be available down the road. The next one really, and this sort of ties in with the traditional IRA, is the distributions that are taxable, which again are going to be the growth, are taxed as ordinary income. And so think about when you make a distribution out of an IRA, make a distribution out of a 401k, that adds to your total income on your tax return, and it's subject to just the normal tax brackets. It's not capital gains rates. It's not tax-free like Roth accounts with no taxes owed. Every dollar coming out, that's in this case, every dollar that's the growth coming out would add to your income, which then could crowd you out of things for like, there's different, if it increases your AGI, this is way down the road, but if you start getting to like, if you're watching this video, IRMA, those type of things are impacted by that stuff. Hans and I were talking about it beforehand. Let's say you do get to, someone who's 20, maybe 18, 19, they're going to school, they're pulling the money out. That's the gross. So it's not subject to the 10% penalty. That's great. But it's still taxable income, which is increasing their taxes. But if they're taking a minimal amount out, they still have a standard deduction in 2025 that's just over $15,000 per person. So let's say you pulled out $15,000 in this hypothetical scenario. It would be, if it's a growth, it would be taxable, but you have a standard deduction to offset that. So someone who's in these early years, 18, 19, 20, probably has a pretty low income. They probably could get money out at a pretty low tax rate. Even with that, now that 10% penalty is different than the taxes, right? So if they're not using it for one of those exceptions, it could be really low income tax because they have the standard deduction, but there could still be a 10% penalty on top of that. So it's going to be a little bit, confusing when the time comes people start withdrawing money out. You need to be careful with it. But the point being is that the withdrawals that are taxable is taxed as ordinary income, not something else like capital gains, as an example.
Okay. So there's no penalties, no 10% penalty if withdrawn for the right purpose. And again, that's higher education, first home, first child, a number of things. And when we get back to you, which is grandparents looking at setting up accounts for the grandchildren, many times in my experience, this is for higher education. I mean, that's what you're putting the money there for. And then that is a gripe that some people have. They say, well, what if my kid doesn't go to college? Well, so that's a gripe that they have with the 529 plans is we saved all this money, and what if they don't go to college? Well, just so you'll understand, these were set up with that purpose in mind. They can use it for a number of things, but we're going to make the comparison a little bit later. It's been my experience that most of the time people are setting it up for higher education, and I'm thinking that these are going to work out. A 529 plan is going to work out better than these things, but we're going to wait and see. Tom?
Yeah, and so one of the things with this new accounts, right? So the law that created these accounts was written or signed in July of 2025. You can't actually open these accounts until July of 2026, right? They wanted to give the custodians time to be able to set up the back end to create the accounts. They wanted to give the IRS time to provide guidance on how things are going to be handled that are a little unclear in the law. So yes, the accounts are been established in the law, they're not actually effective yet. You couldn't go open one now. That will be a year from July. So July of 2026 is when you can open them. Like Hans mentioned, if you have a child between January 1st of 2025, even if you're watching this, that child would have already been born, obviously, all the way through December 31st of 2028, any child born in that window is still eligible for that $1,000, even though the accounts aren't able to be opened yet. So again, more to come. We'll see which custodians offer them, how you go about doing them. There's more information that they're going to have to release. July of 2026, though, is when you can start opening them. So just mark that down in your calendar if you're interested in these. That's the time to start doing something.
Yeah, we get clients. We debated whether we were even going to do this video with something that isn't going to be around for 10 months or available for 10 months. And our answer, people are asking us. They're wanting these things. They want to know about them. There's discussions. People are reading in the news. And so we just decided to deliver the facts. My feeling is I want to talk a little bit about 529 plans. So a negative to a 529 plan is you have to use it for education. But if you're contributing the money over here for education, that's the main reason for setting up the money that's going to be available to them at 18, then this isn't a problem. Now, 529s work the same way, that they're tax deferred. You put the money in there, they grow and they grow and they grow, and you're not paying taxes currently. And then when they get to be 18 or whenever they go to college, they can make deductions, or you can do it for them, make the deduction, or their parents can, to pay for a college education. Then that money, the growth, becomes tax-free. And that's going to be a big difference between these two, is the kids, if they're spending the 529 money on education, nobody's going to have to pay any taxes on the growth. So that's a plus. They also, the money stays in the guardian's name, or whatever, the parent's name. I mean, I set up mine for my grandchildren and contribute every year. The other grandparents contribute every year. We don't have to deal with this 5,000 annual limit. It's a much higher limit that we're not even touching. And so I put my daughter-in-law down as the owner of the account. Okay, I mean, I set them up for her. And so when my grandchildren turn 18, they're going to have to deal with their mother to get any money out of the account. So I like that piece of this much better. And then if there's still money left in there when they're done with their education, then at some later point, they can be transferred to the parents, or they can be transferred to the actual beneficiary themselves. So, Tom?
Yeah, I mean, I think I'll just speak personally, like what I think I'm gonna do, right? I mean, I have 529 accounts set up for my two kids, and then again, one on the way. The plan will be to set one up for him when he's born. Um, I am probably going to take advantage of the $1,000 from the Trump accounts, because why not? I'll probably will set one up for the other kids just to keep it fair. Uh, but for me, I think I am probably going to steer more towards the 529 accounts. I think I want to encourage them to go to school. That was important for me. I think it would be important for them. Obviously, things don't always go to plan. I know that's true. But I like the fact that we don't have to worry about the basis. We don't have to worry about this. If it's used for higher education, it comes out tax free, right? The 529 accounts, whereas with the Trump accounts would be um, ordinary income on their tax return. So again, uh, I'm curious to see what the adoption rate will be on these Trump accounts. How many people actually use them? It's an interesting idea, and I think there could be things they add to it later that make them more attractive. But again, they're there. I like the 529 accounts. The other accounts that we didn't put on the board, we don't want to go too far into them. UTMA and UGMA accounts, they're going to be probably more similar to the Trump accounts, except the UGMA and UTMA accounts, the growth, any income produced in those accounts while they're being held and the kids are minor, you're still having to file tax returns on that. So in that sense, I like the Trump accounts better than the UTMA and UGMA. It simplifies things a little bit. But again, I think everyone's situation is different. What you're looking for, what your end goal is, can be different. And so I think just reach out to someone like us who really understands all the options available to figure out how best for you to utilize whichever accounts to get to what your end goal is, which might not be higher education, right? It might not be going to college. It could be something else. So that might be where some of these other accounts could be more beneficial.
Yeah, and then you've got I bonds, which grow tax deferred, and then if you spend the money on education, then they're tax free. So that's an alternative. And then you've got good old fashioned life insurance, which you can set up on all your grandkids and pay a monthly or an annual premium. And that money accumulates. And when they get ready to go to college, we can show you how to access that, or show their parents how to access that tax free to pay for education. And then what's beautiful about it is the kids can pay it back to themselves when they're later working, and they've got life insurance in force in case they turned uninsurable. So that's another alternative. So I want to go back in summary. What we're talking today is the Trump savings accounts. We've talked about all the features, which you don't really need to memorize the details, because when these things come out, we're going to do another video and we're going to say, okay, here they are. And this is exactly what the deal is. And this is how you open one. We're just going to have to wait and see. So what we've talked about today is really the savings account, which is going to fall under the general title of an IRA. And we've talked about taxes, and that's kind of it today. So I want to bring Tom back on. I want to thank you very much for listening. I'm Hans Scheil.
And I'm Tom Griffith.
Thank you.
Thank you.